I think Lyft stock can beat the market by a wide margin over the next 5 to 10 years. And this really comes down to a combination of a great valuation for this company and also growth potential, not only from the core business, but also the company moving into autonomy. So that's what I'm going to dig through today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. Thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start with some of the information about Lyft's recent earnings report. This is their gross quarterly bookings. I'm just going to start with that because I think this is kind of the key. This is the big metric that tells you how much demand there is for the company's products. $3.3 billion worth of gross bookings. You can see that that was up from Q1 2023 at just $3.1 billion. So an all-time high, growing 15% year over year. That's phenomenal growth for a company trading at this current valuation. And let's go through some of those valuation numbers really quickly. Price to earnings multiple on a trailing basis is over 200. That looks really expensive. But if we look at a forward basis, price to earnings multiple is just 11.1. The enterprise value to sales multiple is just 0.7. So the investors are not giving a lot of credit for Lyft being a growth company, a profitable company. But if you can see with this trend that the company's margins, free cash flow have all been getting better year after year. That's why management even announced a small buyback program in the most recent quarter. And if you look at a metric like their adjusted EBITDA and margin as a percentage of gross bookings, you can see that this margin not real high because that gross bookings number, they're not going to generate all of that as revenue. 70% or so of that revenue is going to be given to the driver as what they make from each ride. Lyft is going to keep the other portion. And so the margin as a percentage of gross bookings isn't going to be, 20, 30%. 2.6% is going to be a pretty good margin. But that gets you to $113 million in just quarterly adjusted EBITDA. Remember, a company that's trading for a $5 billion market cap, this is a run rate of nearly $500 million worth of adjusted EBITDA. Free cash flow, there's a lot of things that go into free cash flow. So don't take these trends as something that's going to continue into the foreseeable future. The two big things are going to be their insurance reserves. That's going to ebb and flow over the years. The other thing is accrued liabilities. That's something that was a tailwind in the most recent year, has been a headwind a couple of years ago. So this will kind of go back and forth, but the company is in positive free cash flow territory at this point, and they expect that to continue. Adjusted EBITDA margin as a percentage of gross booking is going to go down just slightly. They talked about that a lot on the conference call, that there is some pricing pressure. There's a lot of competition in this space, but 2.2 to 2.3%, pretty solid. And for the first quarter, adjusted EBITDA, nearly $100 million, gross bookings up 10 to 14% year over year. So a solid double-digit growth company trading for just 11 times forward earnings. That's a great position for them to be. But what really separates Lyft and makes this a potentially 10x opportunity is the company's autonomous driving ambitions. Not a big business for them today, but if you just look at what management said, this is their CEO, David Risher, who wrote this. And it says that there's basically six segments that you have to put together to get a fully autonomous fleet to actually work. You need, obviously, the self-driving technology, the vehicles themselves, who's going to own the vehicles, and who's going to basically own the fleet itself. Or is this going to be individuals? Is there going to be small companies that are going to own 10, 20, 30 vehicles? Is it going to be a huge company like a Lyft or an Uber who's going to actually be owning vehicles? These are things that all have to get worked out. And then you have to have the mobility platform and rider demand and experience. This is basically Lyft's current business today. And just to kind of summarize all of this, what he did is put together this image, which I think puts together where Lyft sits pretty well. Lyft is going to be the company that is going to operate this mobility platform, have the rider demand and experience. So that's going to include all kinds of new things like advertising revenue that they're going to be able to build into the platform. It has the payments infrastructure, all the forecasting and insurance, making sure the identity of the people who are getting into vehicles is who you would expect. All of that stuff is going to be handled by Lyft. But this is the piece that I think is really interesting, is flex drive. One of the questions that vehicle owners are going to have to answer is, who's going to actually maintain the vehicle? Who's going to keep it clean? Who's going to make sure that it's charged? Who's going to make sure that maintenance is done on the vehicle? Is that going to ultimately fall to a company like Lyft? Well, even Waymo, as they launch their vehicles and scale their business even more, they're trying to figure out how do they offload those day-to-day operations to other companies. Sometimes they're working with a company like Uber to do that. Sometimes they're working with a third party. Sometimes they're doing it themselves. But that's something that they don't, Alphabet and Google as a company just doesn't want to be involved with that day-to-day operations. They just want to do the technology behind it, the self-driving technology, and then the technology that's the marketplace. That's where they actually provide real value. But that day-to-day stuff isn't something they're going to be really interested in. Lyft actually has a business. FlexDrive is a business that connects vehicles with drivers. If you don't have a vehicle, you can go to FlexDrive and say, hey, you know what? I want to make some money working on Lyft. Do you have a vehicle that I can rent? And they can do that through FlexDrive. So that's some infrastructure in about 25 cities they're going to be able to use for autonomous driving. Potentially puts them ahead of the game, something that Uber is going to have to build out with their network. But you're talking a much, much bigger network with Uber. So Lyft can really scale this business in those 25 markets potentially. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. On top of that, it certainly seems like what they're going to do is lean on partnerships like you see here with Marubeni. They're going to have fleet owners owning the vehicles. Basically, Lyft has already said, we don't have any interest in being the owner of the vehicle itself. We just want to be the platform, the ride-sharing platform. So we're happy to partner with whoever it is, whether that's May Mobility, Mobileye, Volkswagen, Zoox could potentially be a part of this, Tesla. Any of those companies could be on the Lyft network in the future, and they'll just be a company that's providing some of that infrastructure, that charging infrastructure, and then also the ride-sharing platform itself. So that, I think, is a phenomenal position for Lyft to be in. Gives you a lot of growth potential because you have two tailwinds behind you. One, you have the growth in autonomous driving itself. So could the number of rides 10x over the next decade just from more autonomous vehicles being available? Then you have the number of vehicles with human drivers available today. Those costs are probably going to come down by somewhere around 50%. I think that could potentially 10x the size of the market. The other thing is Lyft has a relatively small market share. So could they take market share from Uber, especially in the US and Canada where they actually operate, maybe even move internationally? I think that's another growth potential. And at the same time, you get Uber stock at a very, very reasonable valuation. So you add all of these things up, and I think you have a really solid company today with Lyft with a lot of growth potential. This is exactly what I'm looking for with asymmetric investing. Relatively low downside risk with almost infinite upside. If some of these growth avenues really hit, especially with autonomous driving, I like to say that Lyft is the one company here that could really burn the boats and say, you know what, we're going to go fully autonomous in this one city. We're going to get rid of all of our human drivers, and we're going to massively increase the amount of supply that we have in the market. That's how they could take market share in a really big way. But we'll see how this plays out. That, like I said, low downside risk, high upside potential with Lyft. That's why I think this is a stock that can outperform the market by a wide margin over the next 5 to 10 years. But let me know what you think in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.